the provision of budget 2023 have been released, and one of the provision which is going to impact almost every corporate is regarding the allowance of expenditure where the vendor is a micro, small or medium enterprise. So what this provision basically says is that when a company makes payment to an MSME, the sum payable by the assessee to a micro or a small enterprise beyond the time limit specified in section 15 of the Micro, Small and Medium Enterprise Development Act shall be allowed as a deduction only on actual payment. Now, basically, what happens is there are 2 points here. One is the time limit under the MSMED Act. If the payment is made beyond this time limit, then the payment will only be allowed as a deduction only when the payment is made. What this means is it's important to know what is the time limit under the MSMED Act. So the MSMED Act provides that if there is a written agreement between the two parties as to when the payment has to be made, the payment should be made within that time period, which cannot be more than 45 days. However, if there is no written agreement, then the payment has to be made within 15 days. What this means is that in respect of an expenditure, which is governed by an agreement, if the payment is made beyond 45 days, then it will be allowed as a deduction only when it is paid. Secondly, if there is no written agreement, then the payment should be made within 15 days of the receipt of the invoice. And if that is not done, then again, it will be allowed as a deduction only when the payment is made. If the payment is made before 31st of March, then the deduction will be allowed in that same financial year. If it is made after this date, then the deduction will be allowed in the next financial year. And the reason for that is that there is no provision here under which the payment can be made before the due date of filing of return of income. However, there is one catch which one needs to be aware of. If you make the booking anytime between 17th March and make the payment within 15 days. So let's say you took an invoice on 17th March and made the payment on 1st of April, then the payment has been made within 15 days, right? Assuming there is no agreement. In such a case where the payment has been made beyond this time, within the time limit specified in section 15, the deduction can still be claimed on accrual basis because it is within the time limit provided by the MSMED Act. Now, if there are further clarifications on this or any changes, then this position may alter. Otherwise, this is how the thing stands as of now. Now, this next provision deals with the carry forward and set off of losses by startups. So what happens is that under the Indian tax laws, where there is an Indian company which can be an eligible startup, if there is a change in shareholding of this Indian company, which is not a listed company, then the business loss that it has incurred in earlier years may not be allowed to be carried forward. However, in order to provide certain benefits to the eligible startup, there was a provision or a relaxation which was given whereby if the original shareholders, let's say these are the shareholders who were owning 1000 shares, which initially contributed 100% of the shareholding. Then some new shareholders came in who were invested into 9,000 shares, and thereby the new ratio was 90% with these people and 10% with these people. So basically, the relaxation that was provided was that even if there is a change in shareholding, whereby not more than 51% people who were owning the shares earlier no longer continue to own that 51%, if the erstwhile shareholder continue to hold on all the shares which were held by them on the date when loss was incurred, on the date when the set-off is claimed, it will be allowed to be set off. But this benefit was given only in respect of losses which were incurred within a period of 7 years, beginning from the year in which the startup was incorporated. So let's say if the startup was incorporated on 1/1/2017, the losses which were eligible for such a set-off were the ones that is incurred for a period of 7 years, beginning from the year. So 17-18 would be the first year. And it is only the losses which were incurred, let's say 18-19, 19-20, 20-21, 21-22, 22-23, 23-24. So all losses incurred in these 7 years will be eligible for set-off even if there's a change in shareholding, as long as these shareholders continue to hold all the shares. This period of 7 years has now been increased to 10 years, meaning thereby that if the same company had losses in the year 24, 25, 25, 26, 26, 27, even these losses will be eligible for set off. Again, like I mentioned, this is only in respect of business losses and not in respect of unabsorbed depreciation. Unabsorbed depreciation is governed by the provision of Section 32, and it will continue to get the benefit which is available therein. Now, there's a positive development for the startups under the provision of Budget 2023, wherein what has been done is that there was a benefit which was available to the startups. So if this particular startup was carrying out an eligible business and it was an eligible startup, there are conditions attached to what is an eligible business and what is an eligible startup. That is something which is not a subject matter of discussion of this short video. But if these conditions were satisfied, that is, the startup was carrying on an eligible business, it was itself an eligible startup, then it was allowed to claim a deduction for 3 consecutive assessment years out of 10 years beginning from the year of incorporation. So if, let's say, the company was incorporated in 2021, it had the option that, let's say, for year up to 2031, within this period of 10 years, any of the 3 years it can choose, which should be consecutive, and the profits of that will be exempt from tax. There will be 100% deduction for these profits which will be given. There were certain conditions, of course, which were attached, which is that the total turnover should not exceed 100 crores. It should hold a certificate for eligible business, and it should be incorporated on or after April 1, 2016, but before 1st April 2023. Now, what the government has done in this budget is that they've said that not only the companies which are incorporated before first date of April 2023, this 23 will be replaced with 24, meaning thereby that even entities which are formed between 2023 and 2024 in this particular financial year will also be eligible to claim the benefit under Section 80IC. What is the benefit that we've already discussed? Now, there are certain small businesses who, under the provisions of Section 44AD, are allowed to opt for presumptive scheme of taxation. These small businesses are the ones which would be owned by an individual, an HUF, or a firm which is not a limited liability partnership. In these cases, what happens is that if the revenue is 2 crores or less, the assessee has an option to declare 8% of the turnover or 6% of the turnover as deemed profits. Now, these two rates come with certain conditions, but that is what they are eligible to. Of course, the assessee has an option that they can always declare a higher percentage or a higher amount as taxable profit. In order to cover a larger number of people being eligible for the benefit of this particular section, the revenue limit, which was 2 crore or less, is now proposed to be increased to 3 crores, which means that all individual HUF or firm other than a limited liability partnership with a revenue of up to 3 crores can opt for the benefit of Section 44AD, provided the aggregate cash receipts do not exceed 5% of the turnover. So this would be a welcome step, which is going to help a lot of businesses in this direction. Certain assessees, namely individual or firm, which is other than a limited liability partnership firm, who were carrying out profession which are covered under Section 44AA1, namely legal, medical, engineering, architect, etc., were eligible to opt for a presumptive rate of taxation under Section 44ADA. The condition for these professionals were that the revenue should be 50 lakh or less, and in such a case, they had an option to offer deemed income as 50% of the gross receipts. Of course, if they wanted, they had an option to increase the amount offered to tax beyond 50% of the gross receipt as well. In order to provide a larger number of professionals an option to come and offer their taxes under this presumptive scheme, now it has been provided that the revenue limit of 50 lakh is increased to 75 lakh, provided the cash receipt do not exceed 5% of the gross receipt of the professional. In other words, an individual or a firm other than a limited liability partnership can now offer presumptive scheme under Section 44ADA, where their revenue is 75 lakh or less. Now, under the provision of the Income Tax Act, which exists as of now, a gift of any money without consideration exceeding 50,000 from a person who is an Indian resident to a non-resident who may be an individual or a foreign company, right? This is subject to tax in the hands of the non-resident under the provision of Section 918 of the Income Tax Act. However, it was seen by the government that in many cases, the recipient, instead of being a non-resident, was a not ordinary resident. But because not ordinary resident was not covered for taxation under Section 918, they were escaping income taxation on such income. Now what has been done is in this budget, there has been an amendment under which any sum of money exceeding 50,000 rupees received by a person who is a not ordinary resident without consideration from a person resident in India will be taxable as income of the NOR, not ordinary resident, in India. And this will be done under the provisions of Section 918. Now, basically, in the case of Real Estate Investment Trust, often referred to as REIT, and Infrastructure Investment Trust, referred to as InvIT, the rule for taxation is that the income that they received in case of REIT by way of rent, or in case of InvIT by way of dividend and interest, are not taxed in the hands of the REIT or InvIT. Rather, the distribution of such money by these REIT or InvIT to the unit holders is taxed in the hands of the unit holder as if the rent or dividend or interest was directly received by the unit holder. Certain people were misusing the provision of this particular part because of the fact that what was taxable in the hands of the unit holder was referred to as distributed income. And how smartly they were misusing these provisions is that there was, instead of declaring the money that they REIT and InvIT received by way of rent or dividend and interest further at the same nature, what they were doing was that they were showing this as repayment of interest, repayment of loan. So what happened is that even though REIT got the income by way of rent, it got the income by way of dividend or interest. When the repayment was being made, it was in the nature of a capital payment. Because this capital payment did not fall in the four corners of distributed income, therefore there was no taxation in the hands of the unit holders. Now, under the new law, or the proposed provision which is there, what has been provided is that any sum of money which is received by the unit holder from the REIT or InvIT, other than the rent, dividend, or interest, will be taxable in the hands of the unit holders as income. And what is received is now, instead of distributed income, referred to as sum. However, to ensure that wherever there is a redemption by REIT or InvIT and the money received by unit holders is not taxed, it has been provided that such redemption proceeds will be reduced from the cost of acquisition of the unit in the hands of the unit holders instead of being taxed under this provision. Now, this is a provision in case of certain non-residents and foreign companies where they opt for presumptive taxation. So Section 44BB and Section 44BBB are the ones which, according to the government, were being misused. And how was this being done? 44BB is applicable in case of a non-resident who provides services in connection with or supplies plant and machinery on hire for prospecting, extraction, production of mineral oils. In such a case, they are able to offer 10% of the receipts which are calculated in the manner laid down in this section as their deemed income. Similarly, foreign companies who are engaged in the business of civil construction or erection of plant and machinery in connection with a turnkey power project approved by central government are also able to apply for presumptive basis of taxation. Now, according to the memorandum which has been given in connection with this section, the government believes that many companies, what they were doing was they used to opt in for these provisions in the year when they had profit, and whenever they had losses, they used to opt out of this. The impact of this was that whenever there was a loss and they opted out for this, they were able to carry forward the loss and unobserved depreciation to succeeding year. And when the profit used to happen, they used to set it off against the losses which they have been able to carry forward in earlier years. To curb this practice, what has been provided is that as and when the company opts for 10% or presumptive rate of taxation under either of these two sections, they will not be allowed to set off any brought forward losses or unabsorbed depreciation against such presumptive income. So when you opt for a presumptive income, you have to pay taxes on that. You can't set that off against brought forward unabsorbed depreciation or losses and thereby cause a loss of revenue to the exchequer. Now, in certain cases, what happens is that there is a tax assessment which is done either by the assessing officer or the commissioner appeals. And this assessment we are referring to is in the context of transfer pricing. Presently, the time limit for providing the information requested by the assessing officer or the commissioner appeal is 30 days from the receipt of the notice, and this can be further extended by another 30 days at the request of the assessee. Now, given that the timelines have been squeezed for the assessment, the government feels that this time limit of 30 days, initial 30 days, is something which is very high. And therefore, what has been now provided that instead of 30 days, the time limit now stands reduced to 10 days. However, at the request of the assessee, depending on the circumstances, this can be extended by another 30 days. Now, what this means is that a person needs to keep all the documents relating to the transfer pricing assessment ready, because if you do not provide these documents in 10 days, there are penalties which are involved, and the failure to meet the arm's length condition can also result because an adverse order can be passed. Under the existing provisions of the Income Tax Act, in case where an Indian company issued certain shares at a premium to another resident, and the government felt that the price at which the shares have been issued is greater than the fair value computed in the prescribed manner, the difference between the issue price and the fair value was considered as taxable income in the hands of the Indian company. Now, what has happened now is that this provision is also sought to be extended to non-residents. In other words, if a non-resident subscribes to the shares of an Indian company at a premium, and the premium is, after considering the premium, the issue price is greater than the fair value of the shares. Here, the fair value is generally done as per the cash flow method, discounted cash flow method, or other method which results in calculation of the market value. Then the difference between these two will be treated as taxable income in the hands of the Indian company and taxed at income from other sources, which means this will be taxable at the rate of 22%, 15%, or the earlier tax rates plus applicable surcharge and cess in the hands of the Indian company. Now, this is one provision which one would need to watch out very, very closely in respect of foreign entities, and one would need to see whether this results in the taxation of income in the hands of the Indian company.